G'day guys, and welcome back to another episode of the Aussie Investing Machine. In this episode, I wanted to take a look at two stocks which have been very popular this week. Those two stocks are CIMIC and DOU. DOU is a company that is recently listed on the ASX, so we'll take a look into detail about what they do and what their future prospects are. And CIMIC is a more established civil construction company. They both had a good rise in share price, so we'll go right into the details of why that has been the case. If this is your first time on the channel, make sure to hit that subscribe button to stay up to date with all the latest ASX news. And don't forget guys, make sure you hit that like button. It's super important for the growth of the channel and I'd really appreciate your support. As always guys, this video is for educational purposes only. Before making any investment decisions, you should go and see a licensed financial advisor. So let's first talk about CIMIC. CIMIC is an Australian construction engineering company comprised of a number of smaller companies under their umbrella. Some of the big companies that operate under the CIMIC banner include CPB, Contractors, Leightons and Tees. CIMIC's main focus is on large infrastructure projects. I'd say if you're familiar with many of Australia's big infrastructure projects, chances are that CIMIC is involved in some capacity. At the moment, the future is looking pretty bright for CIMIC and we've seen their share price lift. This is due to the Australian federal government's promise to spend more on infrastructure. If we have a look at the graph on screen, you can see just how many infrastructure projects are currently underway and planned for the next 5 years. There's a mountain of work out there, and if CIMIC can make the most of its opportunities, there's a lot of money to be made. If we have a look at some of their projects currently under construction, we're looking at massive developments like Brisbane Airport, the Canberra Light Rail, the Cross River Rail Tunnel in Brisbane, Melbourne's Metro Tunnel, and Sydney's second stage of their Metro Tunnel. These are all landmark projects across the country and have really big significance in Australia's infrastructure plan. As you can see from that graph we put up before, there's more of these projects coming online in the next 5 years, and this presents some big market opportunities for CIMIC. It's clear that Australia will be heavily reliant on big infrastructure spending to pull its way out of the COVID-19 recession. This is a big positive for CIMIC as a company, as they have proven experience delivering these big infrastructure projects. CIMIC also has a mining infrastructure arm, which I touched on before. That company is called Tees. Similar to the public infrastructure projects, mining infrastructure projects will be significant to the rebound of Australia's economy. This puts Tees in a good position to also benefit from the ongoing Australian mining operations. So it all seems pretty good for CIMIC, but let's have a look at how the company's history has gone. We know that big projects come and go, and so has CIMIC's share price. The company follows a price cycle because of the nature of these projects it takes on. This means it has highs and lows on a regular, recurring basis. At the moment, the price is definitely on and up because of all this additional infrastructure spending that the government is really focusing on at the moment. Similar to the big miners, if you're considering an investment in CIMIC, it's really important to know where they are in the price cycle. To really get good value for money, you want to be buying these companies at the bottom of a cycle just before a boom. So timing of your purchase of a company like CIMIC is really important if you're looking for good returns. So now that we know a little bit about the company and its prospects, let's take a look at some of the risks that could affect a large construction engineering company like this. With the size, complexity, and sheer scale of the projects that CIMIC is involved in, there is obviously some big risk involved. I wanted to go over two examples of issues that are currently unfolding on projects that CIMIC is a part of, so you can get a bit of an understanding about how these risks actually materialize. The first project I'll talk about, which I've mentioned previously on the channel, is a transurban development. It's called the Westgate Tunnel. The Westgate Tunnel is being constructed by CPB, which is one of the companies under CIMIC's umbrella, and also another civil builder called John Holland. There's been big controversy in the media over this project due to a massive blowout in costs. These additional costs are to do with contaminated soil, which was found along the pathway for the tunnel. CPB are claiming that this contaminated soil is a latent condition. They're claiming that They weren't aware that this would be discovered during construction. There's an ongoing legal battle between Transurban, the primary developers, and CPB as they try and sort out exactly who will pay for the mess that has unfolded. At the moment, they're flagging about a $3 billion cost blowout on the project. This is a huge amount of money, and someone will be held accountable or potentially partially accountable for the cost blowouts. If CPB has to bear some of these costs, obviously this will have a big impact on CIMIC's bottom line. These are not small numbers we're talking about, and this is just one of their projects under construction. The second project I'd like to touch on is WestConnex in Sydney. This is a road tunnel under the city, and construction has been completed already. What we've seen in the media relating to this project recently is damage to properties which lie above the tunnel. There's been an apartment building which is situated right over the tunnel pathway, which has had some severe structural cracking. It's yet to be determined if the tunnel and soil movement as a result of the tunnel's construction is responsible for this damage to property, but if this is the case, there could be some huge repercussions for CIMIC. People have been moved out of this apartment complex, and there's likely going to be some structural rectification works. In addition to this, if the tunnel is the cause of the problem, there's going to have to be further investigations on other properties that are situated above the tunnel to see what their risk of potential structural issues are going forward. This means that CIMIC, if found guilty, could be up for compensation for people who have to be moved out of their homes, but also paying for the structural rectification works on potentially multiple buildings along the tunnel's pathway. This is another one that remains unresolved, but I think it's a potential big risk for CIMIC. Let's move on to CIMIC's balance sheet. We'll take a look at how their financials stack up. On their balance sheet, there's nothing super impressive. Last year, the earnings after tax was negative, and therefore their earnings per share was also negative. There's also no clear positive growth in their revenue. In addition to this, their debt to equity ratio is very poor. This company is carrying a lot of debt, and their shareholders' equity is not building consistently year on year. These financial metrics are quite typical of these big construction engineering companies that operate in cycles. They have a lot of plant and equipment that requires continual maintenance and improvements, hence the high debt levels. As I mentioned earlier, you need to be really careful if you are interested in an investment like this. You need to choose your entry time really wisely. It's also worth perhaps looking at some of their competitors, which may have more stable balance sheets. A company that I like and that I've invested in the past is a company called Douugh. They are involved in similar big infrastructure projects, but their balance sheet is a lot more consistent. Certainly the profit margins for these big construction engineering companies hovers around 10%, which is not really an adequate buffer if they have a hard year or some unexpected issues arise. So with this, it's reasonable to expect some volatility. Again, do your own research and check out all of CIMIC's competitors before making an investment decision. Okay, so the next company I wanted to talk about in this video is a company that is recently listed on the ASX. The name of this company is called DOU, and they're an upcoming neobank. You might be asking, what is a neobank? A neobank is a purely online bank. They don't have any physical branches or any staff that someone can go and see in person. DOU described their product as a smart bank account, which is backed by the government for deposits up to $150,000. They operate predominantly as a technology company. DOU is putting a lot of work into their mobile banking application and also their artificial intelligence, which is to help improve your financial well-being. Essentially, the artificial intelligence is to help you manage your money better. It helps you create saving targets and keep track of all of your spending right down to the last detail. The product that they offer is obviously geared towards millennials. It's not for those with established wealth and finances. This is very clear by their guaranteed deposit limit. I think it might have increased from 150 grand to 250 grand, but certainly people with more than this amount of money would probably look elsewhere for their finances. The other important thing to consider is that they don't currently offer any loan facilities. So this product is strictly for those people who are saving and spending. They do have a partnership with MasterCard, which means that you can use your debit card linked to your DOU account in a wide variety of places. Their balance sheet is very typical of an early growth company. There's not a lot to touch on here. other than the fact that they have very low levels of debt, which is a positive. I think the focus should be more on their future potential, so we'll get into that. DOU compares themselves to other neobanks, which could be seen as competitors. Most of their competitors hold an Australian banking license, which means they actually deal with the money of customers themselves. DOU says this system is capital heavy to run and is more like the traditional Big Four banking style that we've seen over the past 100 years. What DOU does differently is that they partner with banks in the different countries that they operate. This means they're not handling any of the money themselves, and it means therefore they're running a very light capital operating environment. It also means there's no need for them to gain a bank license, as they're relying on their partner banks to fulfill this obligation. Whilst there may be additional costs for DOU by using partner banks, not needing to acquire a banking license means their ability to scale and expand into many different countries is really, really high. What's interesting with DOU is looking at their Australian competitors. These competitors are Cinja, Volt, and 86400. Those three neobanks are not yet listed on the ASX. This puts DOU in a unique position as they're the only neobank with an IPO. What's especially interesting is that those three banks I mentioned also all hold a banking license. This means that the business fundamentals of these three other Australian neobanks differs quite substantially from the model that DOU operates on. We can see this table that DOU has created for their investor presentation, and you can see those three banks which are in Australia and some of their other competitors which are in the US. As you can see, it's only some of the neobanks in the US that operate on a similar model to DOU and don't hold a banking license. I think this is a unique value proposition for DOU, being the only Australian neobank to date that doesn't operate on the idea of holding a banking license. Will this make the company more successful in the long term? Well, that's yet to be seen. They're yet to prove their business model, but there is a lot of initial support behind their ASX listing. The benefits of not having to acquire a banking license are apparent, and the scalability of the company is one of these key reasons. Essentially, this means the potential for growth for DOU is a lot higher than some of those other neobanks we mentioned. I was looking at one of their main competitors, which is called Volt. There was an article on Yahoo Finance I was reading, and it said that while 86400, which is one of the neobank competitors, has lent out $30 million, and Up, another neobank, can lend via its partnership with Bendigo Bank, Volt and Cinja have been left stuck operating at a loss in the deposit market. I think this statement is really significant. It shows that of the current neobanks that are operating, the only ones that are doing well financially are those that can offer loans. At the moment, DOU has no loan facility. I think from reading the company's investor material, you can see how DOU will get around this problem. They note that they will bring in a subscription service in future, and the main selling point for this subscription is their artificial intelligence, which helps you with your financial goals. This is DOU's unique value proposition, and it's their method of trying to differentiate themselves from their competitors. So the question is, will the subscription service be enough to make DOU competitive in the market? We'll have to wait and see how this plays out for DOU, but my gut feel is that they're probably going to need to establish a lending facility in addition to their subscription service. One big positive about these neobanks is that there's certainly no shortage of demand for the product. In that same Yahoo Finance article, it talks about Cinja, who launched with the best interest rate and was actually forced to temporarily close to prevent customers from opening up new savings accounts because there was so much demand. This is really a crazy statement. A company has to close its doors because there's simply too many people who want the product. I think this is really exciting for DOU, and if they can nail their product, there's definitely a lot of market potential here. It's also probably the reason that we're seeing so many competitors. So in summary, I think DOU is one to watch really closely. If they can successfully implement a subscription service and also gain lending facility, I think they're in with a big chance. They've also been operating in the US market for a period of time now. So having both an Australian and US base means more access to customers. I bet there's also some learnings from competing against some of the US neobanks, which will give them an edge on some of these Australian upstarts. I think their next lot of results is due in February next year, so that's what I'll be waiting for before making an investment decision on this company. I'd love to know your thoughts on DOU. Have you made a purchase yet? Where do you think their share price is going? Make sure to leave a comment below. Well guys, until next time, that's all from me. Thanks so much for watching. Don't forget to subscribe and like the video. Until next time, I'll catch you in the next one. Cheers.